Hi, this is Eric Bissonnier. So last week I did a few videos on the mess in the oil market for French viewers, and I thought I'd do a summary for the week in English. So I'll keep it short-ish, but we'll talk about. I'll go through what I had quite a bit of feedback on how I approached it, and it seemed to have been useful because the information has not been very clear. And hopefully this will make it easier and enlighten the issue. So so what we heard is that the price of crude has gone significantly negative. Minus $37 was the number that was printed. It actually was negative for many contracts, more obscure ones, like Alaskan Oil minus 44 and some others. But the main one that we heard about was WTI. As it said here, a benchmark US crude like Brent in Europe. It's actually quite different, but we'll start with that, which fell to minus 37 per barrel. Well, that's not quite what happened. To be precise, the May WTI future, which expired on Tuesday, April 22nd, closed at this price, which is not quite the same as the WTI benchmark oil contract, which would have meant would have you believe that oil was actually at minus $37. It's actually not what happened at all. What happened was that the WTI contract, and we'll see what we mean by that, actually indeed went down to minus $37, but it's only the first contract, and you can see here generic first CL is actually a WTI contract, unhelpfully, but generic first future. So this is the graph of the generic first future. Now what's the generic first future really? Well, first let's start with what the future contract is. The future contract is an obligation, this is very important in this case, an obligation to buy at a preset time, so in the future, 1,000 barrels of WTI crude in exchange for the physical delivery a few weeks later. So on April 21 was the May contract, because you were fixing the price on April 21 and then getting delivery sometime in the future. And actually for that particular contract, the delivery is in Cushing, Oklahoma. And that is exactly where the problem was. So let's have a look at Cushing first, and then we'll have a look at that contract. Cushing is in the middle of Oklahoma, pretty much the middle of nowhere, and you can see it's a place where a lot of pipelines are going. Some coming from the fields in the south, some coming from the fields in the north, all the way up to Canada. So there's a lot of everything is actually pointing to Cushing. And it's an oddity that actually comes from the contract itself. So let's have a look at the contract. So now we're on the website of the CME, which has the description of the official description of the oil futures contract. And I'm looking at the specifications here, and you can see it's 1,000 barrels, and it trades in dollars. It's 1 cent per tick, and so on and so forth. And then you have something interesting here, which is that the delivery shall be made free on board at any pipeline or storage facility in Cushing, Oklahoma. So that particular contract, the WTI contract, the delivery is in Cushing. It can't be anywhere else. Now, we've seen before that that's the reason actually why. It's a chicken and egg, but that's the reason why Cushing is seeing all these pipelines. And obviously Cushing, which is indeed in the middle of nowhere, or in the middle of the US, and then you go to the flat fields here in the Midwest, and this is Cushing. And you can see the storage facilities here. These are the famous ones that satellites look at and assess depending on the size of the shadow. You can see the top of the silo here, which is either up or down. So it gives you an idea when you look at it every day. It gives you an idea as to how bad stocks are or not. Obviously, on there they know. Each of these facilities know how much they have. So there's quite a few there. There's a few in construction there, obviously. A few more up north. We don't know when this one was taken because that's a Google Earth picture. And you can expect that a lot of these are actually full by now. And in fact, there's supposed to be 15 million barrels of inventory, of free inventory left, but we actually don't know. So what's happening then to that CL1 contract? The buyers that do not want to be delivered roll into the next contract. It's called CL2. The next contract, which in this case was the June contract, which matures on May 20. And they do that during the last few days of the maturity of the future. And what happened there is that there was a confluence of events at the same time. So typically the buyers that do not want to roll are hedge funds and CTAs, so machines that trade futures, including commodity futures, ETFs. And we'll get back to that. ETFs, which are largely invested in that first contract, and that was extremely painful. They're not in the oil ETFs are actually invested in the futures contract, and up until now, we're invested mainly in the first one because there was never any issue to roll. It was very liquid. And traders and speculators in general, speculators is a definition of the exchange, in general, do not want to be delivered. They just take positions based on their expectation as to where the price would go. But this time around, there was another constituency that actually didn't want to be delivered. And these were refiners. And the refiners is quite obvious. They can't sell the oil, the refined oil that they have in stock. So kerosene, petrol, gasoline, and so on, diesel. They just can't sell it because it's not being used. It takes time for companies to acknowledge that this is real and for the wells themselves to be taken down. So we have this glut of supply and no way to store it, because if you don't have refining and you have a lot of production, obviously in the middle, you need to store that. So that's why you have tankers in the port in front of LA. That's why you have, and Singapore, that's why you have these Cushing oil silos that are full. So you have, on that particular day, on Monday, you had only sellers and no buyers whatsoever. And when when you absolutely need to sell and absolutely no one is buying, then the price can become crazy. And that's exactly what happened. The price went down to minus 37. Someone traded at that price. Now it should be taken that in these last 2 days, the volume is very, very low. There's very, very few transactions actually happening, and the price was actually still at 10.15 actually around 10 on Friday. So it really created in the last few minutes of trading on Monday, and recovered somewhat with the fixing being at $10 the next day. The fixing being the last price of that future contract. So the delivery in May was at $10. Now there's we talked about the ETF, and there's something structural about how you invest in markets, right? You think you're buying something, especially with ETFs, and you're actually buying something else. So in the case of oil ETF, and here we're taking the example of the United States Oil Fund, it does say, so it's the oil fund, you're thinking as an investor that you're buying into oil, which you indirectly are. What you're really buying in terms of an asset is the first contract of the WTI futures. And you can see the volume here, gigantic volume of that came to 1.6 billion just a week before these events, and that's, as you can see from an historical chart that goes back to 2006, is a multiple of what typically happens, even in times of great movement, like in late 08, early 09. And the reason is that a lot of retail investors and institutional investors thought that $10, $15, $20 on oil is actually a good price, and therefore I should go and buy that because it's going to come back to 50, 60 sometime down the line. The problem is that you're not buying oil, you're buying the first contract, and there's a few issues with that, which have to do with the market structure. So let's have a look at what the futures look like. And this is a FactSet page of it. So here we have the crude oil contract and actually the Brent with it. You have here the maturity date of that contract, June 20. So this was taken on Wednesday, so or on Tuesday. So when the contract was actually expiring, the one that everybody talked about. And then there's the continuous contract, and you can see the price is not the same as what we saw before. Before we had like minus 37, and this one doesn't. It's like 25, 26. Actually, what they consider being the continuous contract here is the third one, which is this one here at $26. Why the third one? Well, that's because it's more stable than the first one, as we have now seen. So depending on what you're investing in, you're going to have very different returns. And if we look here at the curve itself, so here you have the maturity dates, expiration dates of the futures. And you have here the volume, so how much open interest or how much futures are actually in the exchange. And you can see that most of it has now rolled into the second contract, which is the one in June, maturing on 19 May. And then you have the first contract, which in this print has already matured. It's trading indeed negative. You can see that here. It actually doesn't print negative, probably because the screen doesn't allow for it. But you can see that it's trading negative, and then the first contract is at $20. Now, when you were investing in the ETF, you were expecting to invest in oil. You're actually investing in the first contract, and you see there's a big problem with that. The other issue that we have for the ETF is that the extent of the losses were actually quite surprising. So here is the example of another ETF in Hong Kong, which is the GSCI Crude Oil or Futures ETF. At least it sells its futures, but it doesn't necessarily say it's the first contract. And you can see that it closed down at 46% at 179 on Wednesday, which was after actually the closing of that first contract. So I had to book the losses. One of the reasons why there were more sellers than buyers. And the ETF is this is what Bloomberg mentioned. The ETFs in general have been rattled because of a quirk in the main U.S. oil benchmark WTI, which requires delivering in Cushing. It's not a quirk; it's a characteristic. That's how it is. That's how it functions. And they knew, 20 years ago. So what happened was a real black swan in the sense that what we thought was a very structured market that would function very nicely over time actually proved to be very tricky, not because of a quirk, but because of its characteristics. We never thought the Cushing storage facility would be full, and not for that one, not to such extent that the contract could go negative. And actually, it was confirmed that it could go negative before it happened. But it was really impossible to anticipate. So you're really faced with a typical black swan here. And there's another thing with the ETF, and here it's I took this print later in the week, and you can see. So now the May contract is off, and we have June and July here that I've circled. And there's a pretty big difference between June and July. It was actually at the time $6. It varies, of course, but it was $6 at the time. And you remember that we had $20 for the June contract and minus $5 before. So you could see that the June contract is being pulled down towards, we'll see what price it goes, but towards zero, basically, and maybe even negative. Now, if you're invested in that second contract, which is which is this one, the one at $15. Now you roll it to the second contract, and you go to $22. If nothing changes except time that passes, the second contract will converge to the first one, and that's a $7 difference. That's a $7 difference. And as it converges, you lose actually 31% in just 1 month, just by holding the future as it rolls down the curve. And the whole curve actually goes down like this if nothing changes. Minus 31% in 1 month. So if you're invested if you're the ETF and you're invested in that second contract, you're going to lose minus 30%, and then you roll to the next one and you do it again, and then you roll to the next one and you do it again, and then you can't roll to the following one because you're bankrupt. That's an interesting quirk, and that's why ETFs are quite tricky to handle now. Well, that was the week summary. The week summary of from myself to explain some of the quirks of, so to speak, of the oil market. So the reality is, no, we couldn't fill our tank with negative gasoline, negatively priced gasoline. The issue is with storage. More people wanting to sell because they really didn't want or couldn't be delivered. Up to the extent that they actually accepted the negative price on thin volume, but it's still printed, and this was extraordinary. What's coming next is actually very interesting, because now we know the price can be negative. And what will you do from here? How will you handle your own positions? When will you roll? How far will you roll? The ETFs have opened up to the next 2-3 contracts. So now we're going to have a change in the market structure. And since there's a lot of machines trading these futures, how are they themselves going to adapt to these conditions? Because the flows are going to change, the way the market rolls is going to change, and the negative price is going to have to be embedded in the models. And I'm pretty sure a lot of programmers and traders never thought that was possible. And a lot of models actually do not work with a negative price, especially, as we'll see in the next week, option pricing models. So thank you for your attention, and enjoy your week. Bye.